Now, Mark, you mentioned also FHA loans when we were
Yes,
discussing VA and Freddie Mac.
yes.
Could you go into a description of what an FHA loan is? Because that's probably the most common loan that people hear about that's outside of what, a normal, say, 30-year, fixed rate or
It's,
whatever.
FHA loans are loans that are insured through FHA or Federal Housing Administration. Federal Housing Administration is part of HUD, or the Housing and Urban Development, which is a cabinet in the U.S. government. And basically, what happens is with Fannie Mae and Freddie Mac, if there's private mortgage insurance, the first 25% or so of the loan is guaranteed. With FHA, they have mortgage insurance called mortgage insurance premium. Mortgage insurance premium protects the lender against 100% of the payment of the loan in the event of default. So when you pay PMI or you pay MIP, which is mortgage insurance premium, you're not protecting yourself, you're protecting the lender. And so that's the difference. FHA, for all intents and purposes, is modern subprime loans. Some lenders will close loans with credit scores as low as 500 on FHA. Of course, I can't see how that would happen, because if you have a 500 credit score, it essentially means you've never paid anything on time in your life. There's only 3.5% down payment. None of the money in the transaction can be your own. You can have all gift for the down payment. You can build seller-paid closing costs into the transaction. So it's very flexible in terms of guidelines. And even though the down payments are low, the default rates on FHA loans have not been significantly higher than conventional loans. So it's an excellent product. Fannie Mae and Freddie Mac have competing products with 3% down, but those have loan limits and higher credit score requirements.
Well,
So
you mentioned 3%, 3.5% down, and I think a lot of people get into this idea of like, wow, they're going to borrow so much money. How can they afford if they can't have the down payment? And the reality is that they still have to qualify for that payment. So the cash flow
yes,
still has to be there. We're just talking about their equity value that's in the home. So
correct.
somebody who's going for an FHA loan doesn't mean that they're not going to be able to afford the payment, which I would guess is why the default rates are really not any different than, regular loans that we see.
Correct, and that is correct. And what we've seen, our personal experience with default rates on FHA loans, is debt ratios. In other words, their payments, including their mortgage payment, car payments, credit cards, student loans, alimony, child support, are a higher percentage of their gross monthly income. That points, for us, that's pointed more to default rates than actual credit scores and credit history, believe it or not.
Interesting.
So,
Well, that makes
yes,
sense because if there's these other monthly obligations that people have and they're not, if they got to choose one, right? Oh, well, I'll let
right.
the mortgage go first and do these other things, right?
Yes, they want to keep the roof over their head. And
Yeah.
historically, that's always been the case. And I'll also throw one other thing in there about low down payments. A lot of realtors say to me, well, I'd rather take this deal with 20% down than this deal with 10% down because it's a stronger deal. And my answer to them is, if they meet the guidelines and they're qualified for the loan, they're both strong deals.
Yeah.
They're both good offers. So pick the one that you feel more comfortable with if they're qualified. If you're getting $5,000 or $10,000 more for a house and it's 10% down, take it. Don't 20% down isn't gonna make or break your transaction.
Absolutely.